Well, let's get a move on as well and understand some investment lessons as well, and talk about some interesting philosophies from Rupali Bhansali of Ariel Investments, who joins in to give us some insight into the lessons as well learned from the likes of George Soros. Rupal, thank you so much for taking the time out and joining in. It's an interesting time as well that you're joining us, because the landscape right now continues to remain rather contentious, volatile, ahead of the impending US elections. There are talks of that strong recovery as well, but cases when it comes to the pandemic, they continue to rise. So how are you assessing the overall landscape right now?
I would say that, we are expecting a W-shaped recovery. And so obviously a W is a series of Vs, but that also means that one should not get carried away when one sees sort of the upswings, because they're unlikely to last. So clearly, Q2 was expected to be so bad and people braced themselves for the worst, and it turned out to be better than that because of the stimulus programs. And Q3, I think there was bound to be kind of a bounce back because human behavior, tends to do that. But I would say that COVID is proving to be far more protracted and pronounced, than any of us anticipated. So we should count on this being, for the long haul. Despite a vaccine and despite hopes of things coming around the corner, I think this is going to still be a multi-quarter, if not multi-year event, and we would position accordingly. We're not out of the woods yet.
So Rupal, the global market valuations right now, how do they stack up vis-a-vis emerging markets, including India? How is the picture looking according to you?
Sure. Conventional wisdom would say that markets are not so overvalued, US and Europe, the big ones in the world, on, say, P multiple basis. But I think that's a head fake. One should look at enterprise value to EBIT, because corporates, especially in the Anglo-Saxon Western world, have gone on a debt binge. And if you look at it from that metric, EV to EBIT, markets are extremely richly valued, in particular the US market. In that context, I would say that for the first time in a very long time, I am far more bullish on emerging markets than I have been for the prior decade. And that's because, again, this relative value spread has opened up between developed markets, which are quite expensive, and emerging markets, which have corrected harder, both in terms of stock markets, but also in terms of currencies. So they are a lower base from which you can expect to make more positive returns than in the past. Now, within emerging markets, I would say that in order of priority, as a global investor, I am finding more opportunity in Latin American markets than in Asian equity markets. As you know, Asia has been the favorite of investors for a very long time. And often being the favorite means that, you tend to attract a lot of the flows, and the flows create, their own valuations. And India certainly has been a pretty hot market, for foreign investors for a very long period of time. And that has resulted in the markets not being as attractive, in my opinion, from a valuation standpoint, relative to other opportunities. Now, of course, there are some really fine companies in India, so I'm not saying that there is no opportunity. But if you ask me in the pecking order of where there is more low-hanging fruit, I would say certainly emerging markets compared to developed, and I would say certainly Latin America compared to, say, Eastern Europe or Asia or even India.
Okay, so Rupal, what does it mean for markets? And we're really asking everyone this, whether Trump comes to power or Biden.
It's always a tough thing to do, but I think markets have already priced in, last I checked, a Biden victory. And frankly, when markets have been fairly sanguine about that outcome, as you know from the stock market performance, it's not corrected materially. There's been a bit of a pullback, nothing material. And I think it's more to do with the upswing in COVID cases in Europe than it is to do with, who's going to win the election. Now, that said, no matter who wins the election, it's a lot, in the US at least, it matters about who takes the Senate. And whether there's legislation that can be passed, in particular, if the Democrats take, the Senate and they already have the House, then they can reduce they can overturn what is called the filibuster rules, which require a supermajority, to pass legislation. If they're able to get away with that, then of course, a lot of things open up. And I think you've already heard the Biden plan, so he'll be in a better position to execute on that plan. If they don't win the Senate, then I think not much will change because it's extremely hard to get legislation passed, and you are talking about the status quo. Either which way, whether a Trump win occurs or a Biden win, I would say that tax rates are more likely to go up because the government is facing some serious deficit issues. And the stimulus that they will have to announce, because COVID is proving to be more protracted and the real economy needs help, means even more deficit funding. And in order to finance that, ultimately, revenues have to go up for the government, which essentially is tax revenues. So I think corporate tax rates and individual income tax and estate taxes and sales taxes are likely to go up. And that is a risk that the market is not pricing in adequately, because it believes it's going to be a 2024, 2025 kind of event, back and loaded, which may be the case. But I think stocks are also discounting creatures. And I fear that, if that is likely to happen, the market will start correcting in anticipation and ahead of that. And that does not bode well. In addition, I think that the debt overhang, which has come about, if there is any possibility that the preferential treatment that interest expense gets, for tax deduction purposes is taken away or is abated in some form, which already, did occur during the previous tax legislations, that also does a lot to damage a lot of US companies, which are, in my opinion, quite indebted. So those are the things I would watch out for. Beyond that, I think there is also the ESG factor and the infrastructure spend factor. I think both sides are likely to spend much more on infrastructure. One will call it in the name of climate change and needing to spend, to boost the economy and to do right by the environment. The other will call it as just, boosting GDP. It kind of doesn't matter what label you put on it, but it's pretty clear that both sides are inclined to spend money. So you will see some sort of infrastructure stimulus program being put through.
All right. Thanks for joining us, Rupal. Always great to hear from you and your perspective on how things stand.